Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee, and joining me are my co-host, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewitton, and Managing Director of International Content, Emily Parker. Good morning. I hope you had a nice long weekend.
Good morning.
Thank you. Good morning.
Very restorative. All right, so checking in on Bitcoin right now, the CoinDesk Bitcoin Price XPX Index is currently at $41,630. Bitcoin sliding back a bit, about 2.5% over the past 24 hours. And the CoinDesk Ether Price ETX Index is at 331.38, also retreating almost 4%. The new DFX CoinDesk DeFi Index is at 423 points. DeFi Index there is trading back as well, about 3.2%. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So I don't know, Lawrence, about the markets. Little retreat here and there, support at 40,000, but not really doing much.
Yeah, the only thing worse than the markets right now is my internet connection. Look, we're seeing just overall.
It could drop at any time.
It could drop at any time, and complete chaos here. Stocks are down. The 10-year yield is close to 1.8. It's at like 1.77. So that's kind of scaring people from borrowing. Although that would have been a dream years ago, see rates that low. But energy prices are higher. Some lack of confidence in the Ford administration here. When it comes to crypto, like with Bitcoin, and this was a piece that I wrote over the weekend, we're seeing lower volumes, lower open interest in futures, lower open interest in options. Just overall, like people are like, yeah, this isn't working for them. They're not jumping into crypto as they were a few months ago.
Mm-hmm. Emily, any stories moving markets that you're seeing?
Not much that's moving markets, but, we've seen some interesting news again out of Latin America. We have Brazil, the mayor of Rio, basically saying they're going to put 1% of their treasury reserves into crypto. It's a few days ago, but still kind of big news. CoinDesk also just launched CoinDesk Brazil, so kind of good timing for that. And, still stuff happening all over the world.
Yeah, lots of activity. We see that El Salvador has had their rating downgraded because of their Bitcoin trades from Moody, but El Salvador President Nayib Bukele doesn't care much. All right.
Doesn't give
Taking
something.
a look. He doesn't give something. All right. Acting Comptroller of the Currency, Michael Hsu, also calling for bank-like regulations on stablecoin issuers. Hsu's comments at last week's Transatlantic Finance Forum echoes similar recommendations made by the Biden administration. Joining us now is the former Acting Comptroller of the Currency, Brian Brooks, who is also the former CEO of Binance US and now CEO of Bitcoin mining company Bitfury. Hello there, Brian. Always a pleasure.
Hey, Christine. How are you?
Good. So I know you're not a regular anymore, but you know a lot about the space. And so I'm wondering, should stablecoin issuers be regulated like banks, or should they be considered money services businesses?
Yeah, well, it's a great question. I think that might be a false dichotomy at some level. The theory that we had when I led the OCC was that stablecoins are basically a blockchain native payment instrument. And there are all kinds of payment instruments where, there are either partnerships with banks or not partnerships with banks that are well understood. So in previous historical eras, there were things like traveler's checks, then there were prepaid cards, then there were, other kinds of wire-based money transmission devices. And I guess what I don't understand about the idea that all stablecoin issuers should be banks is the idea that, first of all, under the guidance that we had in our tenure at the OCC, we made super clear which part of stablecoins were subject to bank regulations, and that was the part that involved holding the reserve assets, right? So the reserve assets, we said, had to be in certain kinds of fiat instruments if it was a fiat-backed stablecoin. That obviously is subject to bank regulation because they were bank deposits. They had to be redeemable at par. There were certain other requirements that we put in place. But why the stablecoin issuance itself had to be subject to banking regulation is puzzling. Think about the Bed Bath & Beyond card that you see in the grocery store checkout aisle, right? Bed Bath & Beyond doesn't have to be a bank to nonetheless have a stored value card that is supported by an underlying bank. And so the other thing I don't fully get, Christine, is there are stablecoin issuers that have applied for bank charters and haven't been granted them. So the question I always ask is, if a stablecoin can only be issued by a bank, what's going on with Circle's bank application, and why is that not likely to be granted? To me, that's the most interesting question.
Interesting. I wanted to bring up, you said it wasn't a great dichotomy, but I want to bring up a tweet from Brian Homer. He's a VC at NICA Partners, and he was just tweeting, just read the Acting Comptroller's remarks on stablecoins yesterday, and he's waiting for a good argument for why stablecoins are more akin to banking than money transmission, ignoring the fact that money transmission exists as a regulated activity isn't particularly convincing. I'm wondering if you could weigh in.
Matt's a very smart guy who ran the crypto part of the New York Department of Financial Services as the number 2 official in that organization. So he knows whereof he speaks. I mean, he's the person who did actually used to regulate this activity. So it's an interesting new twist, I guess, on the state-federal balance here, where, at one time the states were mad at the OCC for taking too much power. And now, weirdly, now that the party is in control of the White House that is the same party in control in New York State, there's still tension between those two agencies. It shows how turf wars can be enduring in this space. I think Matt's probably right. I think that what we need is more innovation in stablecoin. The issuance of the token, it doesn't look particularly like banking activity. And given that, why can't we let the existing regulatory regime work? And why do we always feel the need for more constraint versus more innovation?
So, Brian, welcome back. One question I would have in all of this is that where would algorithmic stablecoins fall if they don't actually hold any assets? How would they be regulated? They should be regulated at all, or should it be left over to the free market to dictate its true value?
Well, this is the other really interesting thing, Lawrence. I think that's a great question, is not all stablecoins are fiat-backed stablecoins. And I think it's just a little odd and a little sad that at this point, very few regulatory voices have focused on the crypto native part of all of this, right? I mean, stablecoins that are backed by fiat are basically an on-ramp. They're a transitional technology. They're kind of like the scanner was for the internet 20 years ago. It was a way of getting paper documents onto the internet. But once you live on the internet, you don't really need those things in the same way anymore. And algorithmic stablecoins, which don't present systemic risk to the banking system because they don't touch fiat, probably don't make sense in that regulatory regime. But no one's even asking that question at this point.
So one other question, of course, when you bring up stablecoins, is the use of CBDCs. Now, I don't know if you got a chance to look at our report on Steve Mnuchin's documents and discussions regarding crypto from a couple of years ago. But one of the things that was noted was that Jared Kushner had called for a meeting to create a brainstorming session with different members, potentially of Treasury, et cetera. Do you know if that meeting ever happened to talk about CBDCs? And if so, were you in on it?
Well, I can't really comment about private meetings that happened, inside the government, but I can say that, Secretary Mnuchin, my longtime colleague, has said repeatedly that he's a big proponent of stablecoins. He has his questions about, other crypto activity, but is a strong believer in stablecoins and blockchains as payment mechanisms and payment networks. And so as far as whether that meeting happened or not, I can't really comment on that, but I can say that that was an issue of great interest to him. It's one of the reasons why, under his leadership, the president's working group released the first guidance across the government on how stablecoins ought to be reserved, how they ought to be redeemable, et cetera.
Even though you're saying you can't discuss whether or not that happened, I mean, it was Mr. Kushner involved in any way, considering he wasn't a Treasury official? Shouldn't that at least be public?
Yeah, I can't really comment on that. I mean, there are government agency ethics officials that make determinations about what kinds of things get released to the public and what don't, and that really wasn't my purview. But the good news is, I think we were highly public in our administration about what we were thinking about stablecoins. We gave lots of speeches on it. We released lots of guidance on it. One of the things I've just found a little bit disappointing in, as I think you referred to it earlier, in the Ford administration, is how it's almost as though the government's encountering these issues for the first time, when in fact 18 months ago we spent a lot of time trying to provide clarity about those things.
Brian, nice to see you again. As Christine said early on, you're no longer a regulator. You now have a different perspective. Well, you've been in the private sector for a while, but now you have a different job as Bitfury CEO. Could you just tell us a little bit about what the regulatory space looks like from your perspective now? So are there any regulatory fears that you have for 2022? Like, what's the worst that could happen in the regulatory space that could have an impact on your business or other businesses in crypto?
Well, good Lord, Emily, I mean, if you asked me today what the worst case scenario is, I would have said 2 years ago that the world we're living in today is the worst case scenario. I would never have imagined that the world would look the way it does. But right now, from a regulatory perspective, I'm really laser focused on this House hearing the day after tomorrow on Bitcoin mining and energy consumption, which I'll be testifying at. This is something where I think in discussions with staff, I think there's going to be a bipartisan sort of factual analysis. But you look at the title of some of these things, and they are designed, I think, to stir up passions. And my worry is that there will be governments, it could be our government, could be governments in other parts of the world, that don't take a careful enough look at Bitcoin and proof of work and the value that model adds, not just in the crypto economy, but in the broader energy economy, and will regulate from their hearts as opposed to from their minds. And so, one of the things I'm most worried about is that people don't understand the positive externalities of Bitcoin mining in particular, of the strong incentives that they have for grid balancing and for renewable deployment. And so I hope to explain a lot of that in my testimony on Thursday, but that is a big worry that I've got. Beyond that, of course, there are other things out there that are lurking, sort of ticking time bombs that haven't been fixed. For example, there's bipartisan and bicameral bills pending in both houses of Congress that would correct, the tax reporting provision of the infrastructure bill from last year. But will that get traction? Congress has a hard time taking up small bills. And if that doesn't have a major impact on the DeFi environment and on other decentralized protocols, that's going to be very bad for one of the major areas of crypto activity generally. So there's a lot to worry about. The good news is I think our crypto ecosystem is so much more aligned with each other and so much more sophisticated in attacking these things than we were 2 years ago that I think we'll probably have better outcomes.
So, Brian, you just brought up the infrastructure bill. So, there was such a commotion about that infrastructure bill. And one of the main points was mining. And there were a lot of people in the crypto community warning if the infrastructure bill gets passed in its current form, it's going to have a disastrous impact on mining in the United States. And it could be the end of mining in the United States. And the infrastructure bill hasn't actually been amended, right? It's basically what, the worst case scenario from the point of view of the crypto community. So how would that affect you? Like, say that this infrastructure bill just sort of doesn't get changed, goes through, has this controversial tax provision. How would that affect mining for you?
Well, so look, I mean, there are a whole host of scenarios out there. I mean, one scenario is that these bipartisan bills get passed. I mean, keep in mind, we are still at some level a democracy, and at some point, the majority sort of rules in this country. And what we knew from the infrastructure debate was a majority of both the House and the Senate support correcting it. So plan A is let's get this fixed and let's support, Congressman Chairman McHenry and others who are supporting that. I think there's a chance that happens. Plan B, of course, is the Treasury Department has hinted repeatedly that they'll take regulatory interpretive actions to try and blunt the effect of this on miners and on DeFi project developers and others. Plan C, Singapore, Abu Dhabi. I mean, it's hard to say, but I hope very much that the United States is not truly going to abandon its biggest technology innovation of the last 50 years. I can't believe it will. But for me, I'm focused on Plan A and Plan B at the moment.
And Brian, just a final question here. You mentioned that Circle had a tough time getting their OCC charter in, but I wonder if you have heard anything about any pending OCC charter applications and whether you have any views on whether the Conference of State Bank Supervisors withdrawing their lawsuit against the OCC may mean that, they figure they have a higher chance of approval and getting a charter application.
Well, yeah, I doubt the latter is true. I mean, remember the CSBS withdrew its lawsuit when the OCC won the lawsuit brought against it by New York. So that was not like a withdrawal. That was like an OCC victory, which I think was an easy call, and I always believed it would be an easy call. But I'm glad that it's finally out there. But in terms of what it means for future national bank applications, let's be clear, and this is not based on any inside information, it's just reality. There won't be any new crypto bank charters issued by the OCC in the next 3 years. That is my strong and a strongly conviction, sort of high conviction belief.
Wow. We've got a crypto industry trying to fight for that. But Brian, thank you so much for joining us this morning. Appreciate your insights and your new role. Great to see you continuing to thrive in the space. That was former Acting Comptroller of the currency and Bitfury CEO Brian Brooks. Coming up, FTX Ventures and their $2 billion fund. We'll talk to the new head of the fund, Amy Wu.
Hi, I'm Michael Casey, Chief Content Officer and co-host of Money Reimagined. You're watching CoinDesk TV.
All right, checking in on Bitcoin right now. The CoinDesk Bitcoin price XVX index is at $41,493. Bitcoin sliding back about 2.7%. The CoinDesk Ether price ETX index is at 3123. ETH also retreating about 4.5%. The DFX CoinDesk DeFi index is at 420, down about 3.8%.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
Crypto derivatives exchange FTX is setting up a $2 billion fund to invest in crypto industry startups. FTX Ventures will be one of the industry's largest funds, and at its helm will be our next guest, Amy Wu, formerly of Lightspeed Venture Partners. Hello there, Amy. Thanks for joining us. So, a $2 billion fund. It comes fully from FTX and its founder, Sam Bankman-Fried. Investments could be as low as $100,000 and as high as hundreds of millions of dollars. And you've said the fund could deploy all of the funds by next year. So I wonder what ranks high on your wish list.
Yeah, thanks for having me on. Really excited. FTX, is nothing but bold and its founder, Sam Bankman-Fried. And so with our new venture fund, we are really hoping we first see that the crypto industry is still, I would say, in an early stage in terms of opportunities, innovations, adoption. So just as an example, still less than 20 million people that are actively trading in decentralized finance today. And we want to be part of that ecosystem and accelerating both the pace of innovation and the adoption of it. So we're looking to invest really across Web3 and crypto, some of the areas that we're really excited about, certainly DeFi. We're interested in the number of really interesting L1s and Layer 2 blockchains currently, Web3, so consumer gaming companies, and sort of emerging infrastructure development tooling, and also healthcare.
Amy, welcome to the show. I'm sure you're aware of all the controversy, in which the center of which is Jack Dorsey about Web3 and venture capital. But I'm kind of curious on your take because, Jack, to put it simply, has basically said that VC is bad for Web3 and it kind of like undermines the whole purpose of Web3, right? And I mean, so there's that. And then there's just the fact that VC venture is just exploding, right? I mean, we're just seeing like these funds just popping up everywhere and everyone's raising crazy amounts of money. And I'm just curious, like, how do you respond to that criticism that, VC somehow undercuts this sort of like decentralized nature of Web3?
Yeah, it's interesting because it's an interesting question because there is this strong vein of sort of power, ownership, and influence to the community as one of the underlying principles of Web3. And if you look at the arcs of how trends develop, Web2, how industries develop, there tends to be over time an incentive to move towards centralization. It remains to be seen whether those forces apply in Web3, but I think that at least with our fund with FTX Ventures, we really want to think about those ethos very carefully. What does this mean for how we would support founders and also community members. And we do want to take a very first principles approach into some of the terms of the capital that we want to bring. We are builders ourselves in Web3, and we want to support builders. And so we're thinking about it from, I think, a pretty unique perspective. And we want to be the most flexible capital that they can get access to. And so we are going to be, we're thinking through, and we'll be announcing some of the ways in that we'll really imbue those principles.
Hi, Amy. 6 months ago, FTX went out to the market to raise some money. It raised about $900 million for itself. And now it's going out and giving away $2 billion, essentially, or investing $2 billion. So where did it get that extra $1.1 billion? Exactly what is funding this venture now?
So it is a combination of Sam, our CEO's capital, and also FTX's.
So, but it's in other words, FTX went out to raise that money, and now they're basically doling it out. So why did they go through the process of fundraising to grow their business potentially, and then now go out to other companies and spread it? I mean, I understand the idea of, well, we want to help the ecosystem. It helps our business long term. But exactly when they raised that money, was that the purpose of the fundraise back over the summer, or was it for other reasons? And if so, again, where did it get that extra cash?
It's a good question. So I think there's a lot of reasons why companies raise capital, and the primary and since FTX is a profitable company and doesn't necessarily need to raise cash for operations, the purpose of the raise was primarily to bring on what we think are strategic partners that will help us build to the sort of the next phase of the evolution of the company, and partners like Sequoia and Paradigm and others that came into the round. I would say that was the primary purpose.
Amy, we can't let you go without asking you some questions about gaming, which I know is one of your areas of expertise. So there was actually an interesting article in the New York Times recently kind of talking about how the gaming community is sort of resenting, this proliferation of NFTs, and they feel kind of like they're being taken advantage of, and that these companies are trying to monetize. And I've also heard you talk about it and present the opposite view that, this is a good way for people to actually make money while they're playing, as opposed to just like throwing away countless hours. But I'm curious, like, how do you navigate this sort of rebellion within the gaming community that are just getting really annoyed at all these NFTs that keep popping up in games?
Yeah, it's an interesting phenomenon that we're seeing. So I would say that the gamer community is both incredibly innovative, and they tend to set trends. They are also at times resistant to change as well. And it comes from an underlying it basically shows how passionate they are about the content and the games that they're playing. And we've seen this, sort of resistance to change also from the previous free-to-play monetization chains, kind of the rise of mobile gaming as well. And there are so many gamers and gaming studios today that don't see that as a legitimate type of game, even though today mobile gaming is about 60% of the gaming industry and quickly growing. And I do feel many in the industry feel that this next phase of shift into Web3 gaming is also experiencing similar resistance. But the ironic thing is that gamers actually were the first to really pioneer feeling the value of digital assets and playing with in-game assets and items. And so, quite frankly, I see the next Web3 games as the ability for a gamer to own that asset, and that overall, it is positive trends for gamers. And but I think what will be interesting is that this, because of the resistance, it actually could potentially just give birth to a whole different set of players that are potentially Web3 native, who will be who will adopt this trend first, and also to see whether it is the incumbent gaming studios or new studios that will also embrace the technology and use it in their game in the most innovative ways.
Right. Finally, Amy, I wonder if you will be focused on certain protocols like Solana, which I know is a particular favorite of SBF.
Yeah, I mean, so the Solana team is an absolutely great partner of ours. The fund is going to be cross-chain. So we will be looking at and partnering with other blockchain ecosystems as well. I mean, I think that generally, crypto and blockchain tech is so early that actually supporting the broader ecosystem is really great for everybody. And but of course, we're going to continue being close partners with Solana.
All right, Amy, congratulations on your new role. Looking forward to seeing what develops. That was Amy Wu, investor at FTX Ventures. Coming up, market go up, market go down. Crypto markets update with foreign exchange company OANDA and CoinDesk's Global Policy Regulation Managing Editor Nick Day.
Hey, I'm Isaiah Jackson, host of Community Crypto and author of Bitcoin in Black America. You're watching CoinDesk TV?
The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Joining us now to discuss the crypto markets is Edward Moya, Senior Market Analyst at the Americas at Forex firm OANDA. Hello there, Edward. So Bitcoin is sustaining $40,000 support. Where is the market headed, though? A bit of a retreat this morning.
Thank you for having me. And right now, Bitcoin looks like it's going to be stuck in a range. I think considering how high Treasury yields have been moving, the fact that it's still above 40,000 is still pretty good. Sentiment has been waning a little bit. I think there's a lot of investors that are still anticipating that we could see one last plunge before you have a lot of big investments coming back into Bitcoin. The problem right now is that there's this approach that you're starting to see. There's a lot more attractiveness with some of these other protocols. The growth potential is just much better for some of these other blockchain coins, and I think that you're seeing the Bitcoin trade is still a key holding for every crypto trader. It's just that now, as far as people's portfolios, Bitcoin is no longer 50% of the portfolio. It's now closer to maybe 20% or 30%. So I think Bitcoin is going to have a tough grind, I think, this first quarter. And I think as Treasury yields continue to surge, you're probably going to see the 10-year at 2% a lot sooner than a lot of people were anticipating. And Bitcoin's going to struggle as risky assets kind of go through the motions as far as dealing with these higher borrowing costs. But I think in the end, the outlook is still fairly upbeat, medium and long term for cryptos. It's just this short term. There's just a lot of, I think, de-risking you're going to see with high risky assets. And Bitcoin, through no fault of its own, it's going to probably be penalized for that.
Yeah, welcome back. We're seeing a lot of drying volumes, and it's not just in Bitcoin, though. We're seeing it in ETH as well, and we're seeing even today when we look at some of the altcoins, those layer ones that you were just talking about, they're suffering some bigger losses than Bitcoin or ETH. Do you think, though, we might end up in is there a possibility we might end up in a death spiral, if you will? We have lower volumes causing more people to step away from Bitcoin, if not sell, and slowly but surely work its way down in price, and not just in Bitcoin, but in ETH and in the overall cryptocurrency complex. I mean, is that something that is, at the very least, more than a slim possibility, if you will?
It is a growing risk. And I think one of the big problems over the past couple of months is that you've seen such explosive growth. And I think that one of the problems, the big problem is that you're having too much of the money not going to these crypto coins, but they're going into metaverse bets, they're going into NFTs. And the majority of these NFTs are going to end up being worthless. So I think there's just this unrealistic expectation that you're going to make a quick buck on some of these other crypto related products, and I think people are kind of losing their focus in the short term. But the risk is growing that obviously as you continue to see, I think the focus go into some other coins that might not necessarily succeed. But I think the institutional world is still committed. The retail world, yes, that interest might wane, but I think the institutional world is not going to abandon here. And I think one of the biggest things that we're not focusing on right now is that yes, we always talk about U.S. inflation, but if you take a look at what's going to happen or what is happening across the rest of the world, inflation is running away. Brazil has already delivered 700 basis points in rate hikes since this pandemic, and they can't control inflation. You're seeing a lot of countries that are desperate to find alternative investments, and I think you're going to really see that. Bitcoin, Ethereum, they've been the best performing asset over the past 3 years. People understand that you can have a 50% drawdown at any moment, and this has become accepted. So I think you're probably going to see that a lot of traders, they're anticipating that, inflation is it's going to be a lot worse abroad. And I think it's going to moderate in the second half of the year here, but abroad, it's going to remain extremely elevated. And I think you're going to see that Latin America and emerging markets, Turkey especially, everyone is scrambling to find diversification away from their domestic currencies. So I think that you're still going to see a strong macro backdrop, I think, for the rest of the year for cryptos.
Yeah, we're definitely going to see Bitcoins as an inflation hedge being put to the test. But just to kind of draw some of just the conclusion here. So early on, you mentioned that part of what was happening is that people were diversifying out of Bitcoin into other coins. But I guess my question for you is like the lackluster start of 2022 in the crypto markets. How much of it is just kind of correlating with just the stock market as a whole and just kind of following just the macro trend, whatever is affecting the stock market is just affecting Bitcoin as well? I mean, how much of that do you think is driving this narrative?
I think it's a good part of it, but I think the other part of the equation is you've seen a lot of crypto traders, they've gotten spoiled with Bitcoin and Ethereum. I think when you consider some of the explosive growth that we saw over the past few years, it just seemed that every dip was bought and there was strong bullish momentum shortly after. And now over the past few months, it's really been choppy, and it seems that it's choppy to the downside, and it's a lot of traders. They're just saying, no, this is probably going to be an extended period of consolidation here, and that is not giving them much confidence for putting more or increasing their portfolio right now in Bitcoin or Ethereum. So I think right now there's just more of a cautious approach. They're just waiting to see, do we see 40,000 break? Does it go to 35, 30? And that's when I'm going to become very aggressive in a position. And I think that you're probably not going to see that happen. I think that the institution money is going to be buying well in advance of any major dip that we see. And I think that the move in treasuries is overdone. I think that you're going to see that the balance sheet runoff is probably going to be what keeps the back end of the curve, somewhat capped over these next couple of months, and it's going to be a much more slower grind higher. We have to remember how high yields have risen over the past few months. So I think that crypto should start to be stabilizing, I think, over the next couple of months, but it will be choppy, and we could see obviously some extreme swings.
All right, Edward, thank you for that thorough analysis. That was OANDA Senior Market Analyst, Edward Moya. Time now to check in with CoinDesk Global Policy Regulation Managing Editor, Nick Day. And Nick, good morning. We have a hearing on cleaning up cryptocurrency, the energy impacts of blockchains coming up. Maybe you can give us a preview. We just heard from Brian Brooks, new CEO of Bitfury, say that he'll be appearing on that panel.
Good morning. Yes, Brian Brooks is going to be, I think, the only crypto native representative at that hearing. We do have a witness list finally. And the other, panelists are going to include the CEO of Soluna Computing, which is a data center firm that on its website, they say that they try to find ways of using excess renewable energy to power, small data centers, which, obviously could be useful for crypto miners and individuals who are hoping to, kind of take advantage of this. You also have the former CEO of the Chelan County Public Utility, which is really interesting to me. So Chelan County is in Washington State, and in 2018 they actually imposed a moratorium on Bitcoin miners because Bitcoin miners were taking advantage of low electricity costs and ultimately driving up costs for local residents. So I don't know what to expect of this hearing yet, but the fact that we do have the former executive of a public utility speaking at this with direct experience is really interesting to me.
Is it going to be from the perspective of environmental costs involved in mining, or is it going to be more from the perspective of the ultimate cost to the consumer because of the amount of electricity used? I know in Texas they restricted mining because some of the hydroelectric benefits that were supposed to go to the town were instead going to crypto mining, where it was more profitable.
I suspect it's going to be some combination thereof. The fact that you do have, people from public utilities suggests that they are going to look at the direct cost to the, consumer as well as to the local community. But, you have Brian Brooks, you have people from data centers. So I suspect they are going to look at what exactly, the companies and miners themselves require and whether or not there are ways of lessening the burden, so to speak, on local communities, and just what exactly needs to happen in order to lead to that particular outcome.
All right, Nick, thanks for the update. That was CoinDesk Managing Editor of Global Policy and Regulation, Nick Day. Don't forget to sign up for the State of Crypto newsletter that he writes on CoinDesk.com. Time now for our tweet of the day. And remember how earlier we mentioned that Moody's downgraded El Salvador's sovereign debt due to Bitcoin trades? Well, we've got El Salvador President Nayib Bukele reacting, breaking. El Salvador DGAF doesn't give an F. And we've got a picture of El Todolador.
Yeah, we can't say anything bad about him because he might, put spyware on our phones. So good job.
He's been known to do that to journalists. All right. That's it for First Mover. Thank you, Emily. Thank you, Lawrence. I'm your host, Christine Lee. Meantime, check out The Hash at noon Eastern and all about Bitcoin at 3. You're watching CoinDesk TV. Next up, stay tuned for the Daily Forecast with Angie Lau to see what's happening in the Asia crypto markets.
Polygon's mainnet London hard fork launching. What's it all mean? Welcome to the Daily Forecast, January 18th, 2022. I'm Angie Lau, Editor-in-Chief of Forecast News, covering all things blockchain. Well, India-based blockchain scalability platform Polygon's mainnet London hard fork went live Tuesday morning Asia time, allowing better visibility of transaction fees for users. It also introduces burning of the native Matic token. We're going to take a look at that story and a whole lot more coming up. Let's get you up to speed from Asia to the world. Well, let's kick off with some of the top stories coming out of Asia today. First up, Binance is making moves into Thailand. It's exploring a partnership with Bangkok-based Gulf Energy Development to investigate establishing a digital asset exchange in the country of 70 million people, despite the regulatory headwinds it has faced. In its filing to the Stock Exchange of Thailand, Gulf Energy said its expertise in setting up business in Thailand, coupled with Binance's technology, would help the country advance its development of digital assets and blockchain infrastructure. And Binance told Forecast News the first step will be to explore opportunities in an open and collaborative manner, a clue to how it plans to strategically move into a country where it might not be welcome. Just last July, Thailand's Securities and Exchange Commission filed a criminal complaint against Binance for operating a digital asset business without a license. Meanwhile, South Korea's public broadcaster KBS is going meta. It launched a metaverse version of its studios ahead of the presidential election in South Korea in March. Located within Naver's Zepeto metaverse, the broadcaster aims to highlight awareness of the election, with visitors able to check out virtual recreations of its news and political talk show studios, as well as an outdoor stage, which will host coverage of the ballot counting. There's also the opportunity to learn more in the Presidential Election History Hall and to challenge that knowledge by answering election-related questions to escape from a maze. Sounds very metaverse indeed. And since Zepeto has over 250 million users globally, that's a lot of people who could be brushing up on their Korean electoral expertise before March rolls around. You can find those stories and a whole lot more at forecast.news. Well, India-based Polygon's London hard fork has gone live. The upgrade allows for more predictable gas fees, which could make Polygon more attractive to developers. It will also have a deflationary effect as it introduces burning of the native token Matic. Forecast News' Monica Ghosh has more from India.
After trialing the upgrade on its Mumbai testnet, Polygon rolled out Ethereum Improvement Proposal 1559, commonly known as the London hard fork, on its mainnet at block 23,850,000. The upgrade replaces the first price auction mechanism for gas fee calculation with a base fee which depends on network congestion, meaning users can better estimate the cost of their transactions. They can also choose to pay a priority fee to speed up processing. It has also introduced token burning for its native Matic token, and with a fixed supply of 10 billion tokens, this will result in a deflationary effect, with one expert telling Forecast News that will benefit holders, validators, and delegators. Following the announcement of plans for the upgrade in December, Matic spiked close to the $3 mark. However, it has since been hit by wider gyrations in the markets, but in the longer term, he expects it to push back up with the supply reduced.
I think it's not a story for the next 2 weeks, not the story for the next 2 months. Potentially in the next 6 months, we can start to see that thematic that we've spoken about, the burning of tokens, the upgrade, the benefits which come from this, the more transparent processing fees, less spam and faster processing. All of those things will drive the price higher in the longer term.
Matic's price was at $2.20 shortly after the upgrade went live. For Forecast News, I am Monica Ghosh, Pune, India.
Follow the money. That is every scam artist's MO, and it is no different in crypto markets and countries here in the Asia Pacific. In India, authorities are looking into a $162 million altcoin scam. Over in South Korea, prosecutors are demanding life sentences for 7 people caught in a $1.8 billion crypto scam. And now a recent report by Chainalysis says scammers took advantage of DeFi protocols to loot billions in 2021. So what might we see in the year ahead then? Let's find out with Kelvin Lam, CEO of Lithium Finance. Welcome to the DeFi Download, Kelvin.
Thanks for having me, Angie.
You know, it is certainly top of mind for regulators. A recent survey of security regulators has found crypto scams to be the biggest threat for investors. And no doubt, for everybody in the industry, it's also a huge threat. So why is that? Why are the scams the biggest threat?
The primary reason for that is because crypto is going mainstream. And to put that into perspective, I think as we speak, the total market cap for crypto is over $2 trillion right now. And that was about $1 trillion a year ago, and less than 200 billion just a year before that. So on one hand, we have this rapidly growing, relatively new and less understood market with a lot of new investors getting in. And on the other hand, these crypto assets are in full custody of the users, which is a good thing. But unfortunately, it also means that law enforcement would be much harder if something does go wrong in this less regulated space, if you will. So overall, I think that presents, unfortunately, an excellent opportunity for these bad actors, making these less experienced investors highly attractive targets for scams and exploits.
And that, no doubt, that is only going to increase this year as more and more people get into this space. Do you see the size or nature of these scams changing, though, in 2022? What are the red flags to watch out for?
With the growth and value and volume in crypto, I speculate that we will continue to see these scams, unfortunately. That said, however, I think I like to think that investors are getting more sophisticated too. So I'm hopeful that these illicit activities will become a smaller and smaller share of the overall market. At the same time, however, I also speculate that these bad actors are also getting better and more sophisticated. And in terms of the red flags, the ultimate bottom line is that if something sounds too good to be true, that's probably the case. And we probably want to watch out for projects that focus almost exclusively on price and returns, but without much details on, its utility, the problem that it's trying to solve, and how they're going to solve that problem. And that's particularly the case if you find only limited information on the people behind the team. That's always a red flag.
Always do your homework. I get that. This is what we always say here at Forecast.
Absolutely.
But one thing is to do homework. Another thing is to see a lot of hacking happen in this space. Loopholes in DeFi protocols have been blamed for a rise in these scams. So what's the industry's take here?
Loopholes and technical risks certainly are among the key risk factors. Often, just like any other startups, DeFi projects may prioritize speed over perhaps literally everything else, which sometimes, unfortunately, result in flaws and other weaknesses subject to exploits. And these, again, presents excellent opportunities for bad actors, particularly in DeFi, because very often significant amount of money are involved. Statistics that show that unaudited protocols are much more likely to be targeted for attacks. And about 80% of these attacks took place on unaudited protocols, as these audits are taken out to identify vulnerabilities to avoid these attacks and make all these protocols much less susceptible. The good thing that we see is that as the markets and users are becoming more sophisticated, we're seeing more projects investing time and resources into audit, as well as preventing these attacks.
Add auditing to that arsenal of what to keep watch out for. Thank you so much, Kelvin, for joining us to talk crypto scams and how to keep safe. Appreciate it a lot. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Editor-in-Chief Angie Lau. Until the next time.